Let's dive into the world of US government debt, America's IOUs to the world. These are the promises the US makes to pay back money it borrows, and they're at the heart of the global financial system. Every time the US government needs to fund its spending, it issues Treasury bonds which are bought by investors, companies, and even foreign governments. China, one of America's biggest lenders and the second largest foreign holder of US debt, just sold $8.2 billion in US Treasury securities in April 2025. That's a significant move, and it's making headlines around the world. This might sound like a distant financial maneuver, but it's actually a crack in the foundation of the global financial system. When a major player like China shifts its strategy, the ripple effects can be felt everywhere. This isn't just Wall Street drama or a story for economists. It's about power, shifting alliances, and how decisions made in Beijing can echo all the way to your wallet, affecting everyday people around the globe. For decades, the deal was simple. America spends, and countries like China lend. China would buy US Treasuries, helping to finance America's growth while keeping its own currency stable. But now, China's changing its strategy, and the world is watching closely. This isn't just a financial decision, it's a signal that the old rules might be shifting. Is this just routine portfolio rebalancing, or is China sending a message to Washington and the world? The timing and scale of these sales have experts debating what's really going on. The sale is part of a bigger trend. China is slowly reducing its reliance on the US dollar and diversifying its reserves. This gradual shift could have long-term consequences for global finance. Think of it as a quiet, strategic breakup, not a dramatic exit. China isn't dumping all its US debt at once, but it's making a clear move to change the relationship. In this video, we'll unpack what treasuries are, how they work, and why they matter so much to the global economy. We'll explore why China bought so many treasuries in the first place, and how this strategy supported both economies for years. And we'll dig into why China is selling now, what's changed, and what it could mean for the future of US-China relations. Most importantly, we'll see how these moves affect the US dollar, the global economy, and your daily life. From interest rates to inflation, these decisions can have real-world impacts. Because when Beijing moves billions, it can change the price of your groceries, your mortgage rate, and even your job prospects. This is about the stability of the system we all depend on, one that connects every country, business, and household. Buckle up, international finance is about to get interesting, and understanding these moves could help you navigate what comes next. What's a US Treasury? It might sound complicated, but it's actually pretty simple. Think of it as the ultimate IOU, issued by the United States government itself. When the government needs money to build highways, fund the military, or invest in schools and disaster relief, it doesn't just print more cash. Instead, it borrows from investors by issuing treasuries, promising to pay them back, with interest, over time. You can think of it as lending your money to Uncle Sam. In return, you get a treasury security, either a T-bill for a few months, a T-note for a few years, or a T-bond for decades. Each type has its own timeline and interest rate, but all are backed by the full faith and credit of the US government. For generations, treasuries have been considered the gold standard of safety. They're supported by the government's power to tax and its massive, resilient economy. Even in times of crisis, investors flock to treasuries for security. The risk of the US not paying you back? It's almost unthinkable. So low that treasuries are often called risk-free. That's why everyone wants them. Individuals use them for safe savings, pension funds and insurance companies rely on them for stability, and even foreign governments trust them to protect their reserves. Countries like China and Japan buy hundreds of billions in treasuries, parking their US dollars and earning steady interest. It's a way to keep their money safe and liquid. The treasury market is enormous and incredibly stable. Trillions of dollars change hands every day, and you can buy or sell huge amounts with ease, making it the backbone of global finance. Treasury yields aren't just numbers, they set the benchmark for interest rates all over the world. When they move, so does the cost of borrowing everywhere. When treasury yields rise, it gets more expensive for everyone to borrow, from big corporations planning new projects, to families buying homes, cars, or even paying for college. These boring government IOUs quietly shape the interest rates on your mortgage, your car loan, your credit card, and even your student loans, affecting your daily life in ways you might not realize. In fact, treasuries are like the sun at the center of the financial solar system. Global markets revolve around them, and their influence reaches every corner of the world economy. That's why every move in the treasury market is watched so closely. A small change can ripple through stock markets, currencies, and economies everywhere. So when a country like China starts selling off treasuries, it's not just a headline, it's a big deal that can shake markets around the globe. China's US Treasury story is a tale of economic symbiosis, a complex dance between two of the world's largest economies that has shaped global finance for decades. As the world's factory, China earned mountains of US dollars selling everything from smartphones to sneakers to American consumers, fueling its own rapid growth while filling American homes with affordable products. With nowhere safer or more liquid to stash that cash, China bought US Treasuries. At its peak, holding over $1.3 trillion worth, making it a financial powerhouse and a key player in America's borrowing habits. This made China America's largest foreign creditor, giving it both influence and a stake in the stability of the US economy. The arrangement worked beautifully for years. China got a safe investment for its surplus dollars, the US government got cheap loans to fund spending, and Americans enjoyed a steady stream of low-cost goods. But over the last decade, China's been quietly trimming its holdings, signaling a shift in strategy as global dynamics change. From $1.3 trillion in 2013 to about $775 billion in early 2025, and now even lower after the latest sale, China's treasury stash is shrinking, reflecting new priorities and concerns. It's not a panic, it's a slow, strategic shift, carefully managed to avoid rocking the global financial boat. China is diversifying, moving away from a dollar-heavy portfolio and spreading its investments into other currencies, gold, and assets around the world to reduce risk and increase flexibility. The recent $8.2 billion sale is just another step in this long transition, part of a broader plan to adapt to a changing global landscape and shifting economic alliances. Think of it as a diet change, less pizza, more salad. China is rebalancing for long-term health, not just chasing short-term gains. China still holds a massive amount of US debt, enough to matter on the world stage, but the era of endless buying is over, replaced by a more cautious, calculated approach. This is a deliberate pivot, not a sudden exit. China is signaling to the world that it's thinking ahead, planning for uncertainty, and preparing for whatever comes next. The US remains a key player in China's financial strategy, but the relationship is evolving, becoming more nuanced and less dependent on old patterns. The world is watching what China does next. Investors, governments, and analysts are all paying close attention, because these moves could have ripple effects everywhere. Because this shift isn't just about numbers on a balance sheet. It could reshape global finance, influence interest rates, and change the way countries interact for years to come. Why is China selling? It's a mix of strategy and necessity. First, the trade war tariffs and tensions make lending to the US less appealing. Selling treasuries is a subtle power move, a reminder that China has options. Diversification is key. China doesn't want all its eggs in the US dollar basket. They're buying gold, euros, yen, spreading risk. China also needs cash for domestic challenges and global projects like the Belt and Road Initiative. Selling treasuries frees up money for these ambitions. And there's a bigger goal, making the yuan a true global currency. Every sale is a step toward a world where the dollar isn't the only game in town. This isn't just about today. It's a long-term play to reshape global finance. When China sells treasuries, the effects ripple worldwide. More supply means lower prices and higher yields, so the US must pay more to borrow. Higher yields can attract foreign investors, boosting the dollar, at least short-term. But if the world sees China's move as a lack of confidence, it could trigger a broader sell-off. That would shake faith in the dollar as the world's reserve currency. The global system relies on stable US treasuries. Volatility here creates uncertainty everywhere. Emerging markets, which borrow in dollars, would feel the pain first. If other countries follow China's lead, the shift away from the dollar could accelerate. This isn't a collapse, but it's a fundamental change. The post-World War II financial order is evolving. China's sale is a signal. The world is moving toward a more complex, multi-currency future, and the US can't take its dominance for granted. So what does this mean for you? When treasury yields rise, so do interest rates on mortgages, car loans, and credit cards. A small bump in rates can add thousands to your home or car payments. Higher borrowing costs slow the economy. Fewer homes sold, fewer cars bought, less business expansion. Your 401k and investments feel it too. Rising rates hurt bond values and can spook the stock market, but savers benefit. Higher rates mean better returns on savings accounts and CDs. It's a trade-off, bad for borrowers, good for savers. The key takeaway? Global moves in US debt markets hit your wallet directly. The price of your next big purchase, your investments, even your savings, all are connected to what happens in Beijing. In a global economy, no wallet is an island. Pay attention, these shifts matter. Two camps react to China's sale. The Calm Down Brigade says $8.2 billion is tiny in a $27 trillion market. The system can absorb it, and China won't dump everything. They'd hurt themselves. They argue it's just strategic rebalancing, not economic warfare. The US dollar and Treasuries remain unmatched in size and safety. The Sound the Alarm Party sees a trend. China's slow sell-off, gold buying, and yuan promotions signal a move to de-dollarize. They worry a trickle could become a flood, especially if other countries follow. The US's debtor status gives China leverage, and even small moves shift global power. Is this a crack in the foundation or the start of something bigger? Both sides agree the world is changing. The only question is how fast and how far. Stay tuned. You can't stop China from selling US bonds, but you can protect yourself. Watch interest rates. If you're buying a house or refinancing, act before rates rise. Lock in fixed rates to shield yourself from future hikes. Savers, look for higher yield accounts as rates climb. Diversify your investments. Don't put all your eggs in US stocks or bonds. Mix in international assets, real estate, maybe a little gold. Build an emergency fund, 3 to 6 months of expenses in a safe account. Keep debt manageable and live within your means. These aren't flashy moves, but they're your best defense against global uncertainty. In a chaotic world, a strong personal financial foundation is your best shield. China's $8.2 billion Treasury sale is both a blip and a symbol. It marks a world in transition. Old economic relationships are shifting. For China, it's smart diversification. For the US, it's a wake-up call. The impact stretches from global trade to your mortgage rate. Experts disagree on the risks, but the trend is clear. The dollar's dominance is being tested. The future? Not collapse, but a gradual move to a more complex multipolar system. For you, the lesson is simple. Pay attention, stay diversified, and build financial resilience. The story isn't over. These changes will shape the world for years. In global finance, even a small move in Beijing can ripple all the way to your front door.